Perhaps the easiest way to think about it is that whilst each of the underlying stock pickers that we have very different positions to the benchmark, the MSCI All Country World Index, at a country level, at a style level, at industry level, what we try and do is make sure the way we blend the managers is to ensure that all of the outperformance of the benchmark is going to come from pure stock selection. So it looks very different from the benchmark from a bottom-up perspective. But actually looks quite similar to the benchmark when you've blended the managers the way we have from a top-down perspective. And so country positions look similar to the MSCI All Country World Index, so about 60% in North America, for example, that makes up the world market cap. Although we are slightly overweight the UK and slightly underweight Japan at a country level at the moment. And at an industry level, again, looks quite similar to the benchmark. And so the most in three big sectors of information technology, communication services, and financials, for example. Yeah, we've had some strong performance so far this year. So to put that in perspective, we've outperformed the MSCI All Country World Index by 3.4% in the 9 months to the end of September, 3.9% for the 12 months to the end of September. And to maybe put that in some context, year to date, that 9-month period outperformance of the peer group, the global investment trust universe, of some 6%. The trust has actually got some of the largest reserves out there of any of the investment trusts, which has allowed the board to continue with their progressive dividend policy. And so we've now had 54 years of consecutive calendar year increases in dividends. And given the size of the reserves in place, very confident that that will continue for quite some time to come. The major changes at the manager level have been that we had one manager come out, which was Lomas, and we've had two managers come in, which is Metropolis and Sands. So the background was that Metropolis would bring much more of a new approach to value methodology. They've got more of a private equity approach to things, and so it brings something a bit different into the portfolio from some of the other value-oriented managers that we have in the lineup. And Sands, much more of a growth manager, but really focusing on what are going to be the key things that are going to really change industries over the next decade plus, and who are going to be the key beneficiaries of those real changes. So real long-term growth approach. So the blend of those two coming into the portfolio looking very attractive going forward. Yeah, absolutely. It might be worth bringing a couple to life that are different within the value space and a couple to life that are different within the growth space, because it can sound as though, well, you've got half the managers that are more growthy and half the managers that are more value, and therefore they're probably all quite similar to each other, but it's actually not the case. So if we take within the value universe, for example, we have one manager, Lyrical, who tend to focus much more on finding what are the cheapest companies that are out there, and then deciding within that universe which ones are going to not only survive but actually do relatively well because the market has been far too harsh on their valuation. Whereas on the flip side, you've got Vulcan, who would focus on what are the world's great companies that you would happily own if the stock market shut for 10 years. And which of those can we pick up at a bargain at this particular point in time? And so there's not going to be many of those, and that's why they're suited to running concentrated portfolios. But you can see there that you've got two value managers with very different approaches looking in different parts of the universe. And then we've got the same thing going on within the growth space. You have an SGA who are focusing on those companies that are going to be sustainable growth companies, as they call them, ones that will continue to do well for a long period of time because they've got a business model that allows them to do that. Then on the flip side, Sands that have come in more recently that I mentioned might be finding some of the less well-known growth companies that are going to really benefit from structural changes in industries. And so again, we could go through all of the managers and they're all a bit different in each of the spaces, but that was just to try and bring to life how they can be quite different even under the traditional value or growth labels. So what we try and do is make sure that the trust should be able to do well, almost regardless of what is driving markets at a particular point in time, particularly from a top-down perspective. But even it should do reasonably well, regardless of whether we see, some of the big growth stocks that have done well over the last 10, 20 years continue, or whether we see a reversal in that. There's no real reason why the trust can't do well in any of those environments, given it has no style bias or big country or sector biases. But one thing that is definitely a theme through the portfolio is really looking to ensure that we're not going to be hit by the risks of the transition to a net zero economy and a well below 2-degree world, consistent with the Paris Agreement. We put in place a net zero pledge for the trust, and we introduced a number of exclusions in the portfolio around thermal coal and oil sands that only actually led to one stock coming out at the time. But certainly going forward, we feel as though we're going to be very robust in such a situation, which we don't think is necessarily going to be true of a number of other equity funds that are out there.